Good afternoon, ladies and gentlemen, and welcome to the latest installment of the Option Industry Council's webinar series. My name is Mark Benzequin, and I'm a staff member here at the OIC. We're happy that you can join us this afternoon as we're rolling out a new format for today's presentation. We've been collecting your questions and comments submitted via our recent surveys, and we've assembled a selection of them for today's interactive quiz event. That being said, ladies and gentlemen, I'd like to introduce our presenters today, Mr. Joe Burgoyne and Mr. Ed Modla. Joe is a director of the OIC and also serves as a staff instructor, presenting live and in-person options education seminars around the country. Ed is the manager of OIC's Investor Services Group and interacts with dozens of traders just like you each and every day. With more than 50 years of combined experience between the two, we're lucky to have their expertise and knowledge serve as the cornerstone of our OIC educational events. And as I know that both Joe and Ed are eager to get to your questions, let's get right to it. Gentlemen?
Mark, thanks very much. Did you say 50 years? Ed, what's going on here? Hello, everybody, and thank you so much for taking time out. It's really great to be back on the webinar program here. Mark and Bill, we wanted to kick off January just building that foundation or giving people an opportunity to review what they know with options fundamentals. And, I'm going to go through some of the slides today that will, again, speak to the whole aspect of building that foundation of knowledge. And then Ed's going to he's done the heavy lifting. He's going to get into the questions, many of which you may find are a little bit challenging. So, we will get right to it. As I think most of you know, options do involve risk, and they're not for everybody. The industry puts out characteristics and risks of standardized options, which you can get from either the OCC or your broker. Some of what we'll talk about today is, especially the uncovered option positions have significant risk. And that's, to me, the great thing about OIC, it's being out here and helping investors understand the risks and benefits of a listed options product. So, depending on how many of you are first-timers, the OIC is an industry cooperative founded in 1992, funded by the OCC, the Clearing Corporation, which is the world's largest equity derivatives clearing organization, and also the Foundation for Secure Markets. OIC is funded by OCC as well as the various options exchanges. Those exchanges are BATS, BOX, CBOE, MIAX, the Miami Exchange, NASDAQ, and New York, all of whom have one or more different option exchanges. So that's how OIC exists. The funding comes from OCC and the exchanges. For those of you who have heard me before, this is one of my very favorite slides, and it shows the growth of the options industry going back from 73 to, through 2016. On average, we're doing between 16 and 17 million option contracts a day. So, sometimes I speak more to that slide, but I really want to get to the opportunity, especially that Ed's put together with these questions today, some thought-provoking questions. So we'll touch on, again, some of the fundamental concepts. What are options, exercise assignment, in the money, at the money, out of the money, option premium, buying calls and puts, and then, as I mentioned, far more risky selling calls and puts. So I'll speak to that, and Ed will be jumping in with your questions, with his questions, and then towards the end, certainly some of your questions. So defining an option, again, options are contracts that give buyers rights and sellers take on obligations. Buyers pay for the right. Sellers collect cash to take on that obligation at a specified price, the strike price, the all-important strike price, not the underlying price, but the strike price at a given date. And as I said, buyers have rights, sellers have obligations. We love to hammer that home, one of the core concepts. Options essentially, in my mind, they're for risk reduction, in an overall portfolio, as well as income generation. Depending on your strategy, you can use options for stock acquisition as well. And depending on how far down the road you go with your options knowledge, you can use options for, or in lots of different scenarios. So there's lots of flexibility associated with the options product. We've got calls, we've got puts. Equity options, almost each contract corresponds to 100 shares of the underlying, and that's for an individual company, index, or ETF. Again, they're contracts where buyers have rights, sellers have obligations. For those of you starting out, there's this, in my mind, misconception that options are so darn confusing and complicated. And I give you, they can be a little confusing when you get started because for many of us it's a brand new language. They're really not that complicated if you take the time to build that foundation of knowledge. It's just their core concepts, and a couple of them are really important on this slide. You know, options are contracts. If you are long the contract, you get the right to either buy the stock if you're long a call or sell the stock if you're long a put. Again, 100 shares of the underlying at the particular strike price at any time before expiration. That's the long side. If you're short the contracts, again, you take on an obligation. Short a call, you've got the obligation to potentially sell the stock. Short a put is the obligation to buy a stock. We referenced earlier where some strategies, may afford you the opportunity to buy stock at a discount, and that can be selling puts or cash-secured puts. So, again, I'm going to go through a handful of core fundamental slides here. Ed, I'll turn it over to you with the first couple questions.
Sounds good, Joe. Thank you very much. And as Joe said, these questions are an extension of basic material. They were written to be thought-provoking and informative and educational. We think they are, and we hope that you agree. I also want to point out that for each of these questions, one of the selections that you can make is do not know. And if you truly don't know the answer to the question, we ask that you make that selection because it will help us evaluate the content that we presented today and make better decisions moving forward on the material that we present to you. So let's get started right away with question number 1. I will read through each question and the selections and go ahead and make your choice and submit as soon as you feel comfortable doing so. First question is, how is the decision made to list options on a particular security? Is it choice A, options will be listed on any security which has demand from the investing public? The Options Clearing Corporation decides which securities will trade options and are guided by the bylaws and rules of OCC. Choice C, all equities that are trading on a national exchange will have listed options. Or is it D, the options exchanges have discretion over which securities list options and are guided by minimum requirements? So, of course, options are listed. You see them trading out there on various securities. The question is, how is that decision made? Who makes that decision, and where does it come from? This might be useful for you to know if you're trying to trade a stock or an ETF, for example, that doesn't have options, and you might be wondering where does it come from. So I can see we've got a decent amount of answers. The answers that come through are fluid, but I will take a snapshot and see what the choices look like from our audience. Most people think, the majority of people think, the Options Clearing Corporation decides which securities trade options, guided by bylaws and rules. Some of you think it's the exchanges, and a few people think that the investing public plays a role here. Well, the correct answer is actually D. The options exchanges have discretion over which securities will list options, and they're guided by minimum requirements. Each of the options exchanges makes a decision independently, but their requirements are consistent across the board. And you see some of those requirements listed here, that the stock is listed on a national exchange. It has a share price of $3 or more for 5 consecutive days. There's a minimum requirement on the number of shares in public float. And generally, there's at least 5 trading days from any IPO date. Now, again, the exchanges will look at these minimum requirements, but that doesn't necessarily guarantee that options will be listed on a security. The exchanges, of course, are interested in volume and demand, and if they perceive that there's demand out there from the investing public, they will be encouraged to list options. But again, there's minimum requirements that they're bounded by, and if the minimums are all met, they then can make a decision on their own whether or not they want to list. A related question to this, worth pointing out here, is how are strike prices determined, and who determines that? And the answer is very similar, almost identical. The options exchanges, again, have discretion over which strike prices are listed on securities that have options, and that determination is bounded by rules of the exchange. So not minimum requirements, but rules of the exchange. Again, the options exchanges have similar rules across the board, but to give you examples of what those rules sound like, maybe there's only a certain distance from the open market share price that the exchanges are allowed to go. That could be 50%. It might be 100% away from the open market share price. And there's also a limit on intervals. Some securities can have 50-cent intervals between strikes. Maybe that interval is $1. It could depend on the stock price of the underlying security. It could depend on the days to expiration, how far out it goes. Those rules can get a little bit confusing, but the point is the exchanges make the decision on what securities list options, and they're bounded by minimum requirements, and the exchanges also decide what strike prices to list as long as the strike prices in question fit within their rules. Now let's get to our next question. How are our displayed option bid-ask quotes derived? Is the best bid and offer displayed by the exchanges, and it can come from any market participant, including individual investors or professionals? Or are only professional traders or market makers allowed to disseminate bids and offers to the public? Or choice C, do exchanges determine the appropriate bid and offer for each option? So go ahead and think about that one and make your selection. Everyone who trades options, of course, is looking up quotes and to discover what the bid and ask is. And the question here is, where does that come from? Who's putting up those bids and offers and the quotes that you see that you can trade off of? And does that come from anybody or only the professionals or the exchanges? So I can see a number of you have responded quickly on this one, so we will take a snapshot and see what our answers look like. The most popular choice is that offers are displayed by the exchanges from anybody. Some of you, about maybe a third of you, maybe 40%, chose one of the others. Selections. The correct answer is indeed A, the best bid and offer is displayed by the exchanges, and that can be from any market participant. That's important to know because if you place an order with your brokerage firm and you're the best bid or the best offer, one of two things is going to happen. Either your trade is going to get executed or you will see your bid or offer displayed out to the world for a particular option. For example, if an option is one even bid at $1.20, and you want to buy that option for $1.10, you enter that order in with your brokerage firm. If you're not executed and you're the best bid, you will see 110 bid displayed, and that will be your bid. Now, of course, bids and offers are constantly changing for a variety of reasons. As the stock price moves, value of options are also moving right along with it. So the bids and offers are changing as a result of that. And of course, as I just said, as trades are executed, bids and offers are changing as executed trade prices means those bids and offers are now off the books. So the best bid and offer can come from anybody, whether it's an individual, a professional, an institution. And if you have an order in that's the best bid or offer out there, you will see that displayed. Now, the next few sections we'll get into are exercise and assignment and in the money, at the money, and out of the money. So for that, I will turn it back over to Joe.
Excellent, Ed, and I will run with that. So option buyers, as we said, have the right, to buy stock if you're buying a call and to sell stock if you're buying a put of 100 shares at the strike price. Now, if he or she exercises the long contract. And to exercise, you basically just go to your brokerage firm and fill out that notice. And you can do that, in an equity option at any time before leading right up to expiration. That's the case with American-style contracts. And, of course, buyers, as I said early on, pay for rights. That right is the right, really, to exercise, which allows you either to buy or sell that underlying security. Sellers take on that obligation. The buyers pay for the right. They're in control. Sellers take the cash, but they're not in control. They can be assigned at any time. And, again, it's really important to be crystal clear, what the rights and obligations for a call and put are, whether you're buying them or selling them. And you can, as I said, be assigned at any time right up to expiration. And, buyers have the right to exercise. Sellers can be assigned at any time. So, hopefully you do understand that and know what your rights and obligations are. In terms of in the money, at the money, and out of the money, again, we're talking about core concepts here. calls and puts, rights and obligations, exercise assignment, in the money, at the money, out of the money, I assure you, for those of you just getting started, if you're new to options and you can master these straightforward core concepts, you're well on your way to being able to make a decision whether you think options are right for you or not. So we'll go through the calls, and you can see highlighted in yellow, the stock price is 50. So what's an in-the-money call? As Ed has said, you got strike prices all over the place. The stock is $50, so you've got 50 calls and puts. You've got, 40, 45, 55, and 60 call inputs both. So the in-the-money calls, the 40s and 45s, as you can see on the slide, they're in the money. Why are they in the money? Well, the stock is $50. And what does that 40 and 45 call represent? Well, if you're buying it, it represents the right to buy the stock at 40 or 45. Well, if the stock's at 50, that's either $5 or $10 below the price of the stock. It's in the money by that much. The 50 strike is the price of the stock. That's the at the money. And then, the strike price is above the stock. When we're talking about in, at, and out of the money calls, those strikes above the stock on the call side are out of the money. So the right to buy stock at 55 or 60 with the stock trading at $50 is $5 or $10 out of the money. And again, if you're just getting started, that can be super confusing and will really confuse you with the puts. But if you've been around options a little bit, you know this. On the put side, again, stock price 50. So very straightforward. We know the 50 strike is at the money for calls and puts. But we flip it around here because remember, puts are the right to sell the stock, not to buy the stock. So when we buy a 55 put, we're buying the right to sell stock at 55. With the stock 50, that strike is $5 above. Your right is a price $5 higher than where the stock's trading currently, so it's $5 in the money. So the 55 put's in the money by $5. The 60 put is in the money by $10. The 50 put, as we suggested, is at the money, and then the 45 and 40 puts are lower than the stock price. Again, purchasing the put is the right to sell the underlying, so the 45 and 40 puts are both out of the money. And that's how it works. So, Ed, turn it back over to you.
All right, Joe. And as we've said, we'll take those concepts and extend the material out just a little bit for this set of questions and really test your knowledge and see what you know. Our next question here for the audience. Individual investors who are option holders can communicate exercise instructions up until a defined cutoff time. Who determines this cutoff time? Is it brokerage firms, options exchanges, the Options Clearing Corporation, or do you not know? As an option holder, of course, you can exercise your option. Of course, that right to exercise doesn't extend indefinitely. We know it expires on expiration day, but more specifically, there's a cutoff time by which you would have to communicate your intention. So who determines what that cutoff time is? And I'll let people think about this one for just a few seconds as the answers are rolling in. And it looks like we got good response now, so we'll take a look at what the audience thinks. The most popular choice on the board is the OCC. Sets the cutoff time, but really dispersal here of choices across A, B, and C. Let's take a look at what the correct answer is. From an individual investor's perspective, the correct answer is A. Now, all three of those entities have cutoff times, but exercise and assignment activity is a process with steps, and it takes place after market hours. As I said, firms and exchanges in the OCC are all part of the process, and they have cutoff times, all of them, but the process starts with brokerage firms' cutoff times for individual investors. Keep this in mind. As an individual investor, you have a business relationship with your brokerage firm. You don't have a direct business relationship with the exchange or the OCC. So you are bound to the cutoff time of your brokerage firm. It is very important to know what that cutoff time is. Those times are fairly consistent across different firms, but that is not something regulated by the industry. So you certainly would want to find out what's the procedure, how do I communicate my exercise instructions to you, and what is the cutoff time. Certainly you can ask what can happen if you miss the cutoff time or if you're late. From the industry's perspective, you wouldn't be able to exercise. But again, your business relationship is with your brokerage firm. So posing those questions to them, finding out their cutoff time, and being aware that you are bounded by their cutoff time is very important. Next question. Under what conditions is a standard equity option holder allowed to exercise their option? Can they exercise only on expiration day and only if the option is in the money? Can they exercise only on expiration day but regardless of the option's in the money status? Choice C is on any day up until expiration and only if the option is in the money. Or is it choice D, on any day up until and including expiration, regardless of the option's in the money status? So this question centers around your ability to exercise. What conditions might need to apply in order for you to be able to exercise your option? Let's take a look at what our audience thinks. And the overwhelming support is on any day up until expiration, regardless of the option's in the money status. So that is correct. Audience got that one correct. Equity and ETF options are American style. That means exercise can occur on any day up till expiration. And as an option holder, options don't need to qualify for exercise. They can be in the money, at the money, or out of the money. An option holder has paid for the right to exercise and does not need to be bound by any kind of requirements or qualifications. So the correct answer was D there. Most of you got it right. Equity option holders can exercise on any day up until and including expiration and regardless of whether or not the option is in the money. Next question, if you own an in-the-money option at the close of trading on expiration day and do not communicate intentions to your broker, which of the following is true? The option will not be exercised because your broker is not allowed to exercise a contract unless you provide specific instructions to do so. Your broker is required to contact you and ask for instructions, or your broker is allowed to exercise the option without your explicit consent. Choice D is a combination of A and B, meaning your broker will not exercise the option because they're not allowed to, and they're required to contact you and ask for instructions. Again, the circumstance here, you own an option, it's expiration day, the option expires in the money, and you don't tell your brokerage firm anything. Which of these choices here is true? Again, we're getting quick responses, so we'll take a look at what the audience thinks. Big numbers for choice C. Your broker is allowed to exercise the option without your explicit consent. Looks like about 25% of the audience chose one of the other selections. Take a look. The correct answer, again, audience mostly had it right. C. Your broker is allowed to exercise the option without your explicit consent. Of course, the industry has to have default procedures in place. What do they do if you don't tell your brokerage firm what your intentions are? Do they abandon the option or do they exercise the option? Well, in order to facilitate and expedite the process of exercise and assignment, there are procedures known as exercise by exception. What this means is that if the option is in the money by a penny or more on expiration day, and your brokerage firm doesn't hear any intentions from you, they certainly can exercise your option. In fact, it's overwhelmingly likely that they will. So you can expect that to happen. It's very important to understand this, especially if your option is near at the money on expiration day. Exercise by exception by no means is intended to supersede the rights of the option holder. Some individuals refer to this procedure as automatic exercise. I don't particularly use that term because it tends to imply that the option holder doesn't have a right any longer, and exercise by exception is automatic and takes over. That's not the case. This only happens if you don't communicate instructions to your brokerage firm. I also want to point out here, in order to determine the in-the-money status of the closing price of the underlying security is used, and that's during regular trading hours. After hours is not factored in when exercise by exception is applied. So if you owned an option slightly in the money as of the last trade during regular trading hours, and you're watching after hours trading and it goes out of the money and you don't want to exercise your option, you better be certain to contact your brokerage firm and let them know. Because if it's in the money based on the closing price of the underlying security, undoubtedly it will be exercised if they don't hear from you. Question number 6, if you're an option seller, you need to be prepared to manage your account if you are assigned. Which of the following is true regarding option assignment? As soon as an option goes in the money, it will be assigned. B, option sellers cannot be certain of assignment as this decision is up to the option holder. Choice C is all in-the-money options are assigned on expiration day. Or D, option sellers can place a request with their brokerage firm to be assigned at their discretion. Now, some of the things that we talked about over the last few minutes forecast this question and what the answer is. So go ahead and submit your answers. You're short an option. Which of the following is true when it comes to assignment? Of course, you want to know or forecast if you're going to be assigned. It will help you manage your position appropriately. So go ahead and make your selections there. And let's take a look at what the audience thinks. Almost two-thirds selected B, and about a third of you selected either C or D. Let's reveal the correct answer. The correct answer is B. I think this is several questions in a row our audience has done a good job getting, which is good news for your understanding of these core concepts. So option sellers cannot be certain of assignment, as this decision is up to the option holders. Option writers, or writers is another word for sellers, have been paid a premium. Joe spoke to this concept. They're paid that premium and take on obligations. They don't have rights or decisions. Option holders, option buyers, pay for rights and the ability to make a decision on exercise. Option sellers are paid to take on obligations and don't have rights and cannot make that decision. They cannot reach out to their brokerage firm and request to be assigned or to not be assigned. The possibility of assignment depends completely on the decision of the option holder, who can exercise completely at their discretion. So it's very common for option writers to manage their position every day and constantly evaluate the likelihood of being assigned and then determine how to manage the positions appropriately based on different circumstances, and also to be prepared for assignment activity that you didn't expect. So option sellers, again, cannot be certain of assignment at any time. By definition, option holders have that right, and they can exercise, which can put the seller in a position of having to fulfill their obligations at any time. And now we'll speak about option premium. And Joe, do you want to talk a little bit about that?
I sure will, Ed. It's great to see our attendees doing so well here. So option premium, and again, these are the core concepts, and there's no reason to make this stuff too darn complicated. Option premium, option pricing. As I've said, the buyer pays the premium. The slide says non-refundable. That's not my favorite description. You pay a premium, but if your opinion changes, you want to turn around and sell the option, you sell the option, and you get whatever cash is left in the value of that option back. So, that's the buy side. On the sell side, we know you collect the premium. Doesn't mean that, when you buy an option or, take a short side position, sell an option, that you put that position on and hold it to expiration. Statistics say that well over 3 out of 4, over 75% of option trades are closed before expiration. Okay? So, and as I think we know, each contract corresponds to 100 shares of the underlying, which is where the leverage comes in. And as an example, if you got an option contract that's trading for $3, you don't buy it for $3. It's $3 times that multiple of 100 shares. So it's 3 times the 100 that contract would cost, or you would take in $300. But in terms of the price of an option, okay, and option premium, the headline here on slide 29 tells you, this is what it's all about. Intrinsic value or time value. So what's intrinsic value? Intrinsic value is that in-the-money amount that we talked about with the calls and puts, with the stock price at 50. Clearly, the at-the-monies were the 50 call and put. The in-the-money calls were the 40 and 45 strike with the stock at 50 because they were $10 and $5 in the money respectively. The in-the-money puts were the 55 and 60 puts. And so so let's take a step back. We've got actually it's over 4,400 different individual companies, indexes, and ETFs that options are listed on the various exchanges. Over 4,400. There are over 900,000 different series. 850, 900,000. I mean, it's a crazy metrics of technology. pretty remarkably efficient market. But we've got all these option prices, and some of those option prices are in the money. Some of those different strike prices are in the money. And so the strike prices that are in the money have intrinsic value. They have the in the money amount, and then chances are they have some time value. If expiration's tomorrow, maybe that time value is virtually worthless. Maybe it is worthless, depending on how far in or out of the money that option is. Okay, but for all the option contracts that are out there, some of them have an in-the-money amount because those calls and puts are in the money. So you start with the in-the-money amount, and then depending on how much time and how volatile that stock is, you will have time value. So that's what it comes down to. The contract, if it's in the money, has an in-the-money amount. It has intrinsic value, call or put. If it's not in the money, it only has time value. And that time value, we're not going to get into pricing factors tonight, but from a common sense standpoint, time value. Well, how much time do I have? Is expiration tomorrow, or is it a year and a half from now? Is it 3 weeks from now? 3 months from now? So the amount of time obviously is going to make for more time value. And then the other key factor, and there are a few others, but the other key factor is how much does that stock move? What's the implied volatility of that stock? So for those of you a little more advanced and maybe not too familiar with option pricing, go to the website, optionseducation.org. Check out implied volatility. We've got lots of information there. That's really a very important aspect to options, that whole idea of implied volatility. But from a pricing standpoint and a premium standpoint, options, if they're in the money, they've got intrinsic value, and then most options, in addition to that, will have time value. So really that's just a different slide to represent the in the money, at the money, and out of the monies. And Ed, with that, I will turn, this core concept idea, hopefully folks get the simplicity behind it, back to you for another 4 questions.
Sure. We'll wrap some of those concepts together in this set on a few of these questions, but we'll start with this one. When placing an options order, and this may be something you're familiar with if you use any virtual trading systems, but when placing an options order, you will need to designate a specific action. If you had previously sold a put option and would now like to execute a transaction to exit the position, which action would you choose when entering your order? Would it be buy to open, buy to close, sell to open, or sell to close? So again, you've previously sold a put option. You don't want the position anymore in your account, so you want to exit this position. You will have to designate one of these 4 when you enter that order into your platform. So which of these 4 will that be? And we're getting quick responses on this one. We'll get right to it. Audience overwhelmingly believes that it is buy to close, and indeed it is buy to close. Very quickly, the terms buy and sell, they refer to the specific action you're taking place on the current trade. In this case, we're buying back something that was previously sold, so it was a buy order. The second part, the open or close component, determines or distinguishes between opening a brand new position in your account that didn't exist previously versus closing an existing position. In this case, we were closing something that we sold earlier, so buy to close. If you followed all that, that means when we originally sold the put option to begin with, that would have been a sell to open, and then exiting the position is buy to close. So the vast majority of you had that one correct. Question number 8, if you sell an option, that's an opening sell, and it expires worthless, your profit will be the amount of option premium received. While monitoring your account, when will you notice an increase in your overall account balance? Is it immediately when you sell the option, or when the option expires, or gradually over the lifetime of the option? So you've sold an option that was an opening transaction. It ended up expiring worthless. The profit on that trade would be the option premium that you received. When will you notice your overall account balance increase? A lot of responses here, and like 3/4 of you selected A, another 15% B, and very few of you selected C. So we'll dissect this question just a little bit. The correct answer is C. And the key here may be that we referenced an increase in your overall account balance. Here's how that would work in an account. If you sell an option, again, that's an opening sell, The premium from that option will be received in your account immediately, and you would notice that your cash balance has increased immediately by the premium amount. But simultaneously, the option will be entered into your account, and it's a short option, so it will have a debit value attached to it. That debit value represents the value of the option in the open market. Ideally, those two values offset each other perfectly. In the real world, in a live account, that likely wouldn't be the case. But from an educational perspective, the cash balance is a credit. The open position of the option is a debit, and those two numbers offset each other to a very close degree. Now, if the stock moves your way, or if simply the option decays because time is passing, what will happen is that option value will start to decrease. And what you'll notice in your account is the debit attached to the short option position will start to decrease as that option decays. As that's happening, your overall account balance will then start to increase. And that's the crux of this question. When will you see your overall account balance increase? It's not when you sell the option, because you have that cash credit and the position debit that offset each other. But as that option decays towards zero, your overall account balance is gradually and slowly increasing. When you reach expiration, if the option has decreased to zero and expires worthless, your overall account balance will have increased by the option premium amount, but that increase will have occurred gradually over the lifetime of the option. This is important to understand because, of course, as investors, you're monitoring your accounts constantly. Options traders are very active, and they monitor their accounts on a daily basis. So when you sell an option, of course, you want to check your execution price, your commissions, the premium received, and check all of your balances to make sure it's correct. So this concept will help you understand what's going to happen in your account if you sell a put option to open. You should check your cash balance, check the debit in the open positions or the account positions section, and make sure your account overall balance is where it should be. And then as that option value changes, you'll notice that your overall account balance is changing right along with it. So the answer here is C. Your overall account balance changes slowly and gradually as that short option decays. Next question, a little bit of math here. With the stock trading at $75 a share, you sell a put option at a strike price of $80 or a premium amount of $7. How much is the intrinsic value of this option, and what is the maximum profit potential on this trade? I won't go through the choices. You can see them there, but you have a stock at 75, and you sell to open a put option at a strike price of 80, and you receive $7 in option premium to execute this trade. So how much is the intrinsic value, and what is the maximum amount that you could possibly earn on this particular trade? Give you guys a few seconds to think this one through, and then we'll get to the answer. It looks like the answers are trickling in a little bit on this one. People may be struggling to think this one through, but we'll see what the audience thinks. About a third of you responded on this one. A little more than half think it's B, intrinsic value 5, profit potential 7. And we had about a third of you select some of the other choices here. The correct answer is B. The intrinsic value is 5. The profit potential is 7. Of course, in-the-money options are the only options that have intrinsic value. So the first question, was this option in the money? Well, with the stock at 75, a strike price of 80 for a put option is indeed in the money. So that amount is the difference between the strike price and the stock price. That's $5. There's your intrinsic value of 5. And when you sell an option, the maximum profit you can make is the premium received. So that's $7. That's the total premium amount. In order to profit that amount, it's very likely that the stock would need to rally and close at or above 80 on expiration day in order to realize that entire $7. You could hold out that long if the stock rallies. Of course, as an option decays and gets close to zero, it's also very common for options sellers to buy back that option when there's just a few pennies left in it. But of course, the maximum total profit potential here is the premium you received, which is $7. Question number 10. If a stock is trading at $62 a share with 30 days left until expiration, which of the following options would have both intrinsic value and time value? And there's your choices there. Number one is a 60 call. Then you have the 62 call, 70 call, and then you have three put options, the 50 put, the 62 put, and the 65 put. So go through each of those six and determine which of those options would have both intrinsic value and time value, with the stock trading at $62 a share with a month left until expiration. All right, we're getting our answers to come through. Choice C had the most, a little over half, and the other half chose one of the other selections here. Choice C was correct. It comes down to which options were in the money. Only in the money options are going to have intrinsic value. The others won't. And if you looked at those selections that I put up on the board there, of the six, the 60 call and the 65 put were the only two that were in the money. The other four were not. The 62 strike options are at the money, and the other two options were out of the money. Now, all six of them would have some level of time value, even if it's very small. So all six have time value. The question is, which ones are in the money? Which ones have intrinsic value? And based on the six choices available, it was only those two, the 60 and 65 put. The other four, again, would only have time value. The 60 call and the 65 put would also have time value, but because they are in the money, those are the only two correct choices there. So the correct answer is C. And now for our last section, going on outright individual trades, we'll wrap it up with this section here. And Joe, do you want to talk about the four separate outright options trades?
I sure will, Ed. And so we'll start with buying calls, all right? Whether buying calls and next to be buying puts. But think in terms of risk, okay? You're buying, so you have control. You are purchasing the right to either buy stock or sell stock at the strike. So you know going in, maybe the option costs 50 cents, maybe it costs $5, maybe it costs $30, but you are buying the right to buy or sell stock. What's your risk up front? Your total risk is whatever you pay for that option. And, if you happen to purchase that option and you hold it all the way to expiration and the stock doesn't do what you forecasted it to do, maybe you'd lose all of that premium. As I said earlier, 75% of option trades, which are between 16 and 17 million contracts a day, 75% of them are closed out before expiration. So from a risk perspective, when you buy an option, you know your risk going in. It's the debit you've paid. Now, whether you hold that thing to expiration and just if it's going the wrong way, hope and pray that it comes back and that your option, makes you some money, that's up to you. But going in from a risk perspective, your absolute risk, it's the premium you pay for that option. We know that call buyer has the right to buy 100 shares of the underlying at the all-important strike price. And you can exercise that thing, as an equity option anytime between the time you purchase it and expiration. But think about this now. Let's go back to the option premium aspect. Obviously, you're only going to exercise an option that's in the money. But if that option has intrinsic value and also time premium, if you're long that option and you exercise it, you're giving up the time premium. So let's say there's $5 of intrinsic value and say 50 cents of time premium. If you exercise the option, you're going to get the stock at that strike, but you're going to give up that 50 cents of time premium. So that's why, when we start to talk about, short options and this whole idea of exercise and assignment, as an option seller, you can pretty much know when you're going to get assigned. It's when there's no premium left in the option. Because as the option owner, if you own that option for $5.50, $5 intrinsic value, and you exercise, again, you give up, the 50 cents or $50. If you went into the market and sold that option, you would take in that whole $5.50 versus just, getting long the stock, $5 above the strike price if you exercise. So, call buyers know their risk going in, and in terms of the upside, there's unlimited profit potential because theoretically, an option can go to infinity. Theoretically, none of the calls or stocks that I ever purchased went to infinity. I can assure you that. But from a risk perspective, whether it's long call or long put, you know your risk going in. Buying puts, same thing. Difference is that, you can quantify your risk, but the difference here, it's not the right to acquire the underlying, it's the right to sell the underlying. Again, 100 shares at the strike price. You could exercise that put at any time between expiration. Of course, because you are long the contract, you're paying a premium. In terms of, the short side, let's see if we can get a slide here that works. Okay, selling calls. Bingo, that's what we're after. Okay, and it's really important to understand the difference in the risk. Okay, buyers of calls and puts, you can quantify that risk right out of the box. Sellers of calls and puts, you can't quantify the risk on the sell side. You can quantify the risk of a short put, not a call, because the obligation that you take on when you sell a put is the stock going to zero. So you can quantify that, but it's substantial, really substantial. So call sellers, you take on the obligation, to sell the stock at a strike. How much money can you make when you're selling a call and selling a put? Well, you can make whatever you sold that option for, whatever the premium is, but not a penny more. Your risk is completely different, though. As the next slide suggests, there you go. Unlimited loss potential with a short call. When you're just flat out naked short a call. Of course, because of the additional risk, your brokerage house is going to ask you to put up a lot more capital. In terms of selling the puts, we talked earlier briefly in one of the first slides, talk about, one of the, potential approaches for people to acquire stock is to sell puts. When you sell a put, you take on the obligation to buy the underlying stock. So maybe you like XYZ, but you like it at a lower price than it's currently trading in the market. You sell that lower strike price. You put up the money, as a cash secured put. So if the stock gets to that price, you can buy the stock at a discount from where it's trading today. If the stock doesn't go to that strike at expiration, then you basically collected that premium. Again, 100 shares of stock, it's at the strike price. You can be assigned any time between now and expiration, but know full well the vast majority of the time you're only getting assigned when there's no premium left in that option, or, and this especially if you're getting, kind of new to options, the other part is if the underlying pays out a dividend. Okay, so if the premium in that option is greater than the dividend, there's a darn good chance that you could get assigned. So, that's what you have to be careful of, that the premium in the option is less than the amount of dividend, the size of the dividend that the stock is paying out. So, last bullet here in this slide, uncovered short put, is the second highest level of risk. First being the short call. The short put has substantial risk because that stock can go from whatever strike you've sold to zero. So with that, Ed, I think I will turn it back over to you. Hopefully I didn't confuse folks with that.
No, sounds good, Joe. And these last few questions that we have here involve a little bit of math, but simple math, so it shouldn't be too complicated. Let's take a look at our question 11 for today. What is your break-even stock price at expiration, excluding commissions, if you purchase an in-the-money call option under the following circumstances? The stock is trading at 60, the strike price of the call option you purchased is 57, and the premium you paid is $5. So in other words, what price of the stock would you need to see at expiration in order for you to reach a break-even point on this trade? Of course, break-even point is very important for you to know. That will likely tie in directly with your market forecast. If you think the stock is going to rally above your break-even point, then you'd be confident that your trade would be profitable. But this is a way to evaluate a particular trade. If your market forecast has a target price for the stock, but you do a little bit of analysis on the options trade and you see that the break-even point is a little bit below where your target is, then that's when you think you might be able to profit on the trade. If the opposite is true, then you might want to reconsider the trade that you are making. So again, like I said, simple math here, and almost everybody selected choice D. And from the test your knowledge perspective, you certainly passed on this question. The correct answer is D. The break-even point would simply be when the call that you purchased has a value at expiration equal to what you paid for that option. In this case, you paid $5. In order to break even, the option would need to be worth $5, and the stock would have to rally to 62 to break even. Your market analysis, if you were to make this trade, would likely be for a target price above 62 by expiration. So just about everyone got that one correct. And now we'll get to our last question of the day. How much money would you make, excluding commissions, if the following sequence of events occurred, beginning with the stock trading at $42 per share? You sell a put option at a strike price of $40 for $2.50. You are then assigned on that put option, and you close out the resulting stock position after assignment by selling the 100 shares at $41 per share. And there's your choices on the bottom: a profit of $150, a profit of $250, profit of $350, or would this result in a loss of $150? Sold a put option, strike price $40, you received $250 in option premium for that. After you were assigned, you ended up with a stock position, and you closed that out by selling shares at $41 a share. What is your profit or loss here on these transactions? I'll give you a few more seconds to think this one through. It looks like about half of you have responded, so we will move forward here. The most popular choice was A, 150, and then we had selections across the board. Some people chose each one of the others, B through E. Let's take a look. The correct answer is C. When selling a put option, you receive the premium. In this case, it was $2.50 or $250. That's cash. That goes in your account, and it stays there. If you were assigned on this put option, that means you're buying 100 shares of stock at $40 a share. And as we described in the circumstances, you sold those 100 shares at 41. So purchasing 100 shares at 40, selling another 100 shares at 41 means you made another $100 on the stock transactions. That's in addition to the $250 you received when you sold the option in the first place. That adds up to a total gain of $350. For this set of circumstances here, you see on the bottom, there's another way to look at this that some of you might find easier. If you sell a 40 strike price put for $2.50, that would put your break-even point at $37.50. So when you were assigned, you could look at this as though you bought 100 shares of stock and you are long those shares from a price of $37.50 as your break-even point. It's perfectly reasonable to look at it that way. If you then sold those 100 shares at 41, that's $3.50 higher, and that would give you your gain of $350. So the answer is C, $350. Now, these premium amounts in these circumstances are hypothetical. There's an attempt to use realistic prices. It's just worth noting what your profit was on this trade and recognizing that the stock may have moved against you. If the stock moved down to 41, it may have moved lower, but because of the option premium, because of your ability to manage the position and sell out your shares above the strike price where you bought them, you were able to add to your gain. So it's one of the benefits that you could see from selling put options. So the correct answer there again is C, and that was the 12th and final question that we had for you today. We had tremendous responses for each of these questions that we asked, and it's a new format for us. I want to thank everyone for their participation on each of these questions. I hope you found the format to be useful and informative. And for our final slides here, I'll let Mark take us home to the finish.
Well, Ed and Joe, thank you so much. Ed, I agree. I think the format was fantastic. I thought it was very informative and engaging in the audience. I hope that you'll agree that some of the questions that you were asking or some of the responses that you were sending over the Q&A window shows me that you did agree, so I'm certainly glad to hear that. For the rest of you, please make sure that you fill out that survey and feel free to comment what you thought about the new format. We'd certainly love to get your opinion. In the meantime, a lot of you you did mention additional education and additional resources on our OIC website, optionseducation.org. We do have our options education program, as many of you indicated that you are consider yourself to be beginners to the options game, so we certainly want you to take advantage of that OIC options education program that we have. In addition, we want you to take a look at our mobile app, our YouTube channel, where we have our recorded and archived webinars. Please like us on Facebook and follow us on Twitter, as social media is a way that we enjoy reaching out to people. We also want to make sure that you follow us on our OIC website, that you take a look at our upcoming presentation. So please check out our optionseducation.org website for more details. Our options, our investor services group, you can reach them at options@theocc.com, and we'll certainly be happy to answer any options-related questions that you have. In the meantime, again, I wanted to thank you for attending. Thanks for your time, and we hope to see you very, very soon.